Good morning. I'm Lisa Goldman, leader of the International Tax Group at Berdon. During the last few months, we have all experienced unprecedented times due to COVID-19. It has influenced how we've all managed our personal and business activities. While I have spent my time advising international tax clients impacted by the shelter-in-place regulations, my partners Wayne Berkowitz and Rich Goldstein have been navigating the impact of these travel restrictions on state and local taxation. I would like to welcome Rich and Wayne and our audience to this first of two webinars on COVID-19's impact on state and local taxation. Today's webinar will focus on the impact of the pandemic on individual state taxation. Wayne and Rich co-lead our state and local tax practice, which advises individuals and businesses on the tax requirements of governments and municipalities across the nation. They advise high net worth individuals and businesses across a wide range of industries, planning their tax strategies, assisting them in resolving controversies, and representing them in state tax audits. Welcome, Rich and Wayne. So I know the topic of today's program is focused on COVID's impact on residency, but residency tax rules have been around for quite a while. Rich or Wayne, can you briefly explain why residency is important?
Yes, I'll pick that one up, Rich. Everyone, thanks for joining us today. This is very exciting. We have quite a number of people logged in. The reason residency is so important is because when you're a resident of a particular state, you're essentially taxed on your worldwide income. That means everything. So every single penny you earn, no matter where, is going to be taxed by that state. You may get offsetting credits for that, and often you will, but there's a potential for double taxation if you're a resident of more than one state. You can end up being a resident in a state with a higher tax rate. You could end up being subject to a localities tax that you didn't know of. And the credits don't necessarily take care of everything, as Rich is going to talk about a little bit.
Yeah, sure, Wayne. So yeah, it's true. There's resident tax credit available in most states for taxes that you end up paying in another state where you earn your income, but it's less than 100% beneficial, particularly when it comes to items of unearned income like interest, dividends, capital gains, income from intangibles, unless they're let's say used in a trade or business in the other state. The general idea being that your state of residency is willing to give you a credit for taxes paid to the other state, so long as the income actually came from the other state. And one of the things we find often is during the course of a multi-state audit or a single state audit is there can be a discrepancy between what your resident state thinks was earned in your own state and what the other state thinks was earned in their own state, even if it's earned income. And so that's often an issue where there's potential for double taxation.
How does one determine residency?
Well, just for a minute, I just wanted to step back for a second and say that, the big problem comes when you're resident in both states with your intangible income. And both states are going to claim that, and in most cases, neither state is going to give you a credit. So that's an important thing to keep in mind. For example, if you're a hedge fund owner, if you're run a hedge fund and you're earning intangible income, essentially, and you're a resident of one state and you're a statutory resident of another state, which we'll talk about in a minute, you could end up with a serious tax bill in two of those states.
Very good points. So, but how does one determine residency?
Well, there's two ways. I'm going to talk about the one that everybody knows, which is the statutory residency test. And this is the one that everyone thinks if they're not, then they're okay. So for statutory residents, it's a very objective test that most states have. And what they do is they look for two things. They look if you have a permanent place of abode, and they look if you're in the location, the state, for more than 183 days. Now, there's two very key components to that. What is a permanent place of abode? Essentially, it doesn't mean it's your permanent home. It means essentially any living quarters that is available for your use, that is maintained by you in some way, as long as it has, normal living facilities. People have tried to argue that if they've shut down a place for the winter, that it's not a permanent place of abode. That might work. It usually does not if it does have heat and it could be used. So the standard for what's a permanent place of abode can be fairly low. The other part of that test is the day count test, which, again, a lot of people think if they're in New York, for example, for less than 184 days, they're not going to be a resident. That simply isn't necessarily the case. Also, any part of a day for the statutory residency test is considered a day that counts for this test. So if you come into New York just to eat somewhere, if you come into New York for an hour, if you come into New York to see a show for 3 hours, that counts as a day. Doesn't matter that you didn't sleep in your New York permanent place of abode. So it's very important to keep in mind for the stat res test, there are very few exceptions to the day count. The ones that come to mind are for medical exceptions, which essentially means you're stuck in New York, and also if you're coming to New York just to use the airport, or if you're just driving through to get somewhere else. Those are pretty much the only exceptions you're ever going to see in this area. And just so you know, that staying in for less than 184 days isn't the only test. We're just going to talk about the subjective, very complicated test also.
Yeah, thanks, Wayne. But before I do that, I just want to bring up something that you brought up that's really important and particularly relevant for COVID-19, which is the exception for day count when you're stuck in New York. Wayne, it's kind of limited, right? And it's not clear that it will be useful for folks who are staying in place.
That's a very important question, actually. And correct, the medical exception that they have is generally if you get hit by a car and God forbid have to be taken to an ambulance and you're stuck in New York. That's the very narrow, strict and reading of that exception. And by the way, this exception is only in the New York State audit guidelines. It's not even the law. So this is by grace of the New York State Department of Taxation and Finance that if you're stuck here for a medical emergency, they won't count that day. We've seen it stretched a little further. If people want to come to New York for specific treatments, be specialized, generally if everything else is in order in your audit and you have that issue and you've documented it, auditors tend to be reasonable in that area. But you're right, Rich, shelter in place, nobody knows what's going to happen with that.
Right, very questionable. And just to be clear, what Wayne was referring to with that very specific exception is for New York State. And what we're discussing here applies to many states. So this statutory residency, this 184-day plus maintaining a permanent place of abode, there's a very, very many states that use exactly the same standard.
Mm-hmm.
And then a lot of states will also use the domicile standard, meaning that you can be a tax resident of a state if you qualify under either test. So if you succeed in showing that you were present in a state for less than 184 days, you may still be domiciled there. And if you're still domiciled there, you're still a resident. The difference between domicile and residency at the most basic level is that statutory residency is fluid. It can change from one year to the next, simply depending on, how much time you spend there. Do you meet the threshold of 184? Or maybe you didn't maintain a residence in the state that year. So that changes. Domicile doesn't change frequently, not normally. And everybody is born with a domicile. It's the place that you intend to return to when you're not required to be away from your home. So there's a certain amount of circular logic to it. But it's a matter of intent, and everyone has only one domicile. That is what the Supreme Court has decided. So you can be a tax resident in more than one state, because you can be a statutory resident in one state and domiciled in another. And how do states try and decide whether or not you are domiciled in a state is a matter of trying to figure out what your intent is, and they'll look to things like, if you have homes in more than one state, they'll look at the nature of the home. How is it being used? Is it being used really as a vacation home, as a weekend place? Does it meet the requisite requirements for a family of the size that you have, that it could possibly be your main home? They'll look at things like, where if you have minor children and dependents, are they at that home? Are they going to school there in that state from that home? And they'll look at other things that are in many ways more interesting, like, where do you keep your most near and dear possessions? Where are they stored? Are they stored in New York? Are they stored in Nevada? Where? And things of that nature they could be things of great financial value, like art collections, wine collections, or they can be things that are merely, I don't want to say merely, but things that are of sentimental value and perhaps, no financial value. Like, where do you keep, your children's grade school reports? Things that have personal.
Mm-hmm.
Where's your dog? That's one that's come up a few times.
As a matter of fact, where the dog has come up happened to me on an audit, and I mentioned to an auditor that the dog was at the Connecticut home and not the New York home, and the auditor correctly, somehow he knew this, turned around to me and said, "Wayne, you know and I know that's the farm dog, not his personal dog." And I just didn't know how to answer that, but he knew. So
I would have said farm dogs are people too.
All pets should be included.
Yeah.
Wayne, if we can go back to your description of the medical exception in New York, we had a question from one of the audience members.
Mm-hmm.
Does New Jersey have a medical exception?
I'm sorry, what did you want to know about the medical? There's a medical exception for the statutory residency day count if you are actually stuck in New York for inpatient treatment.
Right.
Okay.
So the question was, does New Jersey have a similar exception?
Well, they don't have it formally. You got to keep in mind, New York has the most developed set of guidelines in the world on this issue, because they have a lot of high-income taxpayers, they have a high tax rate, and they have New York City as well, which has a parallel to New York State as far as the rules. So a lot of people who are New York State residents and might have a place in the city, try to plan properly so to make sure they're out of New York City. So over the years, we have such an extensive set of case law and guidelines. Does New Jersey actually have this in writing? No, they don't actually. But honestly, I'm going to tell you, in my entire career, to every 100 New York State, New York City audits, I've had one New Jersey. And it's not because we don't have clients that it applies to, it's because their program is a lot less active than New York's.
And if I could add to that, I'd like to say that New Jersey generally, in many instances on these issues, is more forgiving, if you will. And in fact, the fact that there is nothing particularly on that point is probably beneficial, because what New York has is so narrow that it's not particularly helpful. I think in New Jersey, we'll have to wait and see, what guidelines come out.
And there's one other important reason I thought of as we're talking about this, why it's not as critical in New Jersey. New Jersey's credit for taxes paid to other states is very generous in that they don't look to sourcing. It's one of the few states that they don't care about the source. If you paid it to the other state, you're getting a credit. Now, I've had to educate New Jersey state tax auditors on this issue, but it is the way the statute's written. So that's why it hasn't come up as much.
Just a much more generous state. in some ways.
Mhm.
One more question for you from one of our audience members, and it's about domicile, and whether one domicile is a constitutional requirement such that two states can't assert that you're a domiciliary in both states, and whether
I think I understand the question is, how can two state, we can say that there's only one domicile, and that's fundamentally correct. It's a matter of law. Can states have a different opinion as to which it is? And the answer is they absolutely can. I had a case involving Connecticut and New York, and ultimately what we needed to do was to get the unit heads of the personal income tax division for Connecticut and for New York State to basically in a room and to come to acknowledge that there was going to be a date at point in time where the domicile changed from New York to Connecticut. Now that's very difficult to do. There is a treaty among some of the Northeast states. I believe Massachusetts is probably included as well, and as well as New York, Connecticut, and New Jersey, where they agree to use very similar guidelines. The bottom line is all states acknowledge there's just one domicile, but it can get tricky, and you can get caught up. But with obviously you need a good representative to help you through that thicket. So
I want to move on a little bit because we're really supposed to be talking about COVID-19's impact on state residency.
yes.
So maybe we can apply what we just spoke about to how the impact of COVID-19 on the state tax residency issue.
Sure.
Rich.
I think that's
Yeah, I'm gonna pick that up. I mean, basically, people have been changing their work-life habits and where they're spending their time. So, perfect example that we have is we have a person who is a domiciliary of Connecticut, and they have a summer home, let's say in the Berkshires in Massachusetts. So they decide they're going to get out of the rat race of Connecticut, I guess, and they're going to spend more than 183 days in Massachusetts. Well, what's the problem there? They are now a dual resident of both Massachusetts and Connecticut. They haven't changed their domicile because they've done nothing else to do that. Okay. They haven't changed their intentions. Their kids are still registered to go to school in Connecticut. In order to change your domicile, the law says you need to abandon your old one and establish a new one. So they've done nothing to do that. They now have spent more than 183 days in Massachusetts. They're still they still intend to return to Connecticut, and now they're dual resident in both states. If they were required to shelter in place, we don't know if that's going to help them for the day count. I think Mass Rich talks about that, and they've given some favorable treatment, but no one knows exactly how that's going to work out.
So, another example of where this can come up is if you have somebody who lives in Connecticut, a family living in Connecticut, but let's say the workers in the house, they work from an office in New York, and now because of the stay-at-home rules, they're working, full time from Connecticut. Something that is very a thorny issue here is New York's has what's called a work-at-home rule, and there's a number of states that do have the work-at-home rule. I think Wayne knows them by heart, but we can get to that. But New York is one of them. So now here you are working from your home in Connecticut because you don't really have a choice, and you're a non-resident of New York, and there's something called the convenience of the employer test work-at-home rule. Suddenly, all that work that you're doing in Connecticut from home is sourced for New York State purposes is considered New York source income and goes on a New York State income tax return as New York source, subject to tax. Connecticut, on the other hand, your state of residency, is not going to give you a credit for that ordinarily, because as far as Connecticut's concerned, New York, if the roles were reversed, New York wouldn't give a credit either. So
It's where you perform the services, Connecticut. They're saying, well, you did the work here, so it should be sourced here.
now, in the context of COVID-19, and I think this is where it becomes really important, is whether or not there's some level of leniency, either on the state of Connecticut giving the credit, or on the state of New York at not enforcing the work at home rule, because clearly it's arguable that the individual is not working from home for their own convenience, which is the test. It's and this, usually you're thinking of, is it the employer's requirement? In this case, it's really the government's requirement, right? So so that's a somewhat of a novel issue, but I think a person would have a reasonably strong argument that during a pandemic, when there's a state of emergency and you effectively cannot work from the office, that's not for your own convenience, and therefore it should not be sourced to New York.
Well, just a little bit of an out there. I mean, New York has a bulletin they've put out. Again, it's not the law, on when they won't apply the convenience rule. And one of the requirements is if the employer is not providing you with a workspace in their New York office. So I think the fact that maybe you can't physically go to your New York office is helpful and kind of meets that guideline. Because I think I think a lot of states are going to be lenient. I don't think New York is going to be one of them.
So just in thinking about this issue, because we have many of our own co-workers and also our clients, employees, that they're working in other states, right? That and not just New York or New Jersey or Pennsylvania. So has any other states besides New York changed the way they're taxing wages during the pandemic?
Well, interestingly, Pennsylvania came out with a position that if there's a person who works for an employer located and they do the work in Pennsylvania, but they're non-resident of Pennsylvania, normally the wages earned while working in Pennsylvania are Pennsylvania source income for that non-resident of Pennsylvania. So Pennsylvania gets to tax the compensation. Now what we have is a situation where the employee cannot work in Pennsylvania because of COVID-19. They're working from their home state. Pennsylvania has stated a policy that says we're going to leave the status quo ante. So those, I'm sorry, that we're going that we're not going to that we're going to leave the status quo ante. Basically, it's going to remain Pennsylvania source income. So even though you are no longer working there, but the flip side of that works as well. So that if you were previously not working in the state, but now you are working at home in Pennsylvania, but that income was earned in another state, normally that suddenly, even though you're working in Pennsylvania, that wouldn't suddenly become Pennsylvania source income, because the only reason you're working in Pennsylvania now is because of the lockdowns. And so the Pennsylvania policy, is a fair policy, because it's just all it's doing, retaining the status quo. In my view, it's fair policy.
I think it's debatable whether it's fair. I think they were trying to be fair when they implemented it, but what they didn't keep in mind is that this can cause you to be taxed twice on this income, because your state that you're a resident of may not give you a credit. They're going to say, hey, you worked at home. God forbid, if something happened to you, our ambulances would come get you. Our police are protecting you while you're working at your home in Massachusetts, and you're doing the work here. So we're providing services to you. We should be able to tax that. And Pennsylvania at the same time saying, well, just because your employer's there, it's going to be sourced to our state. So
right,
could work out, could really cause a mess as well, which it's going to for some people also.
Yeah, I mean, I think you're absolutely right. From a perspective of internal consistency, though, at least they're being consistent with their reasoning. It's not heads I win, tails I win, right? But in Massachusetts, to your point, Massachusetts has issued an emergency regulation to do exactly, to address exactly what you said, Wayne, which is they've said that, look, if as a result of the pandemic, your state is the state of employment is continuing to consider that to be a source income, even though you're working from your home in Massachusetts, which is not the state of employment, and that state wants to tax you, Massachusetts is saying that they will allow the credit for essentially income earned in the state of Massachusetts being taxed by an alternative state. So they're trying to mitigate that and avoid that situation from happening. So that's a bit of good news.
Didn't Massachusetts actually go beyond policy and issue some emergency regulations to do this?
Yeah, it was done through emergency regulation. Yeah. Absolutely.
Which is surprising because everyone else kind of just has a policy statement or a sentence that somebody said during a press conference, as has been happening in New York. That's how we seem to find out most of our information, from the governor's press conferences.
Yeah, we were watching a lot of the governor's press conferences early on, and you know, interestingly, we would get little proclamations from
clues
Governor Cuomo about what was going to happen, and and then we'd have to wait 5 days before the tax department issued something. But it was an interesting thing because you could literally see executive orders being issued before your eyes, and we don't normally see that. It's not something we normally see. So it's interesting.
Sure. Again, we kind of alluded to this, you need to watch out for the states with the convenience of the employer rules again, because you can be stuck having tax twice, especially if they didn't speak to us, if they didn't speak to this issue. States you need to watch out for: New York State, Nebraska, PA, and Connecticut. I mean, as everyone's moving away from the convenience rule, Connecticut actually put one in last year, but they only put it in, Rich, correct me if I'm wrong, for a state that also has one. Yes. And I think this was a direct aim at New York, saying, if you're going to do this to our residents, we're going to do this to your residents. Because Connecticut, at many points during my career, has tried to extend an olive branch to New York to work out the double tax issue, and New York has never really been receptive to it.
So another question, which goes to the employer's convenience. If it's for the employee's convenience, where is it sourced?
Well, it really is for the employee's convenience, but somehow, for some reason, it's called the employer's convenience. I'm not really sure why. I mean, the simplest example of the convenience test is the Zelinsky case, and Professor Zelinsky, who was and by the way, there was $6,000 of tax involved in this case, and only a law professor would litigate it because he has a room full of students to do it for him. And that's exactly what happened here. So Professor Zelinsky was a professor at one of the New York law schools, I forgot which one, might have been Cardozo, not sure, lived in Connecticut. So he spent half of his time doing his work, teaching classes at the law school, and the other half at home in Connecticut grading papers. Classic example. He tried to source half of his income to Connecticut, and the court said no. It went to the highest court in New York, which is the Court of Appeals. The Supreme Court of the Supreme Court of the U.S. denied cert on it. No surprise. But that's the classic example. So as for his convenience, he graded his papers at home. He didn't have to do it. He had a New York employer. That's the classic, simple, straightforward example of it. And New York's highest court has approved it.
Okay. So I think we're going to move on to a different topic. I know with what I do on the international tax front, there are sometimes strategies that we can implement to reduce the tax burden. Maybe you can discuss some strategies to reduce the state and local tax burden?
Sure. So, now is a unique sort of point in time, and it could be actually a really good time to act on an intent to change your domicile if you've been thinking about it for a while. One of the things that the states how they evaluate whether a change has been made is whether or not something identifiable has happened in a person's life. I refer to it as a triggering event, marriage, birth of a child, getting a new job, something that you can look to and say, okay, now we'll take a closer look. Something happened here. And then they look at all those other things that, I discussed earlier, like house, how much time you spend in a place, where you keep your near and dear items, right? So think about it. We have a COVID-19 situation where people are really questioning where they want to live. This is a time where people are going to, reevaluate, perhaps more than ever before, in mass. So let's say we'll take an example of someone who's domiciled again in New York City, let's say, New York, and they have a summer home in Connecticut. Now, a lot of folks in New York have been leaving for other states and going to their vacation homes if they're in less densely populated areas. For a number of reasons, maybe they have more space and it's more comfortable to be in a home than in an apartment. And also maybe the lack of density, there's a perception of greater, safety from the virus and so forth. So maybe that there are folks out there who want to sort of convert their homes that they already have outside New York to their new domicile. And so right now what we have is a good, I don't want to use the word excuse, is the wrong word, but what we do have is a good basis for understanding, why somebody has decided they want to make a change. And now clearly if they were to dispose of their home in New York, they could very easily affect a change in domicile.
Well, that's always the grand slam of domicile
that's
change.
The grand slam. But even then, as you know, even then, there's times where you can get clawed back in subsequently. But so now is potentially a very good time to do that. Now the flip side of that is that this is transitory. This is hopefully a transitory
it is. We're optimists. Yes.
Yeah. And so, if this is if this is going to come to an end at some point in a reasonably not too distant future, maybe, especially if you didn't get rid of the home in New York, maybe the intent isn't really there, and this is just a temporary relocation, and by definition, a temporary relocation,
well,
because of COVID-19 or otherwise, is not an abandonment of the domicile. So that would not work. So it's going to be very fact specific. Everybody's got a different life and a different fact pattern, and so the benefit of changing domicile might be lower taxes, but there really has to be a change in domicile. So you'll have to look at this. People will have to look at themselves very closely to see how their fact pattern works in this situation.
Well, if we could examine it, just and what I've seen happening with clients in light of the 5 primary factors they look at. Look, the home factors are essentially going to stay the same. The business connections factor. A lot of people who are self-employed, have their own, operations or a business that they run, have told us, Rich, they're not going back. Things are going well for them as well as they can at home, and they're not going back. So they're going to work from home. I'm sitting here in my basement right now. Looks like I'm in the lobby of the building, but you probably figured out I'm not. I'm getting things done down here. I miss client contact and my peers, but it's getting done. Near and dear items, maybe you move some of your stuff, maybe you don't. Time spent, it's not a day count test, but it's a quality of time and the amount of time you spend in this new place versus everywhere else. People are meeting that test. I think the biggest thing, and you mentioned that, Rich, is family connections, which is where your relatives, which for I think is the least important factor, except if you have school-age children. Now, if your kid was going to school in New York City beforehand, and you're staying at the Connecticut house now, I don't think it's a great fact if your kid is signing up to attend school online in the same New York City school. I think that's going to be used very heavily against you no matter what. So these are things you'll need to think about. Where do you want to send your kid to school? Taxes are important, but life is important too. So, but those are the reasons why it could be possible and it could happen. And it is changeable. It is doable if, you do all the right things.
We
And
launched
let
our,
me just say that all the right things are going to be different for different people.
And by the way, the right things aren't changing your license,
Right.
changing your voter registration, changing where the cars are registered. Those are what I call the damned if you don't factors. Those things don't change your domicile, but if you don't do them, they're certainly going to be used against you. Those things alone don't change it.
well, we launched our second poll, which is about domicile, and we had about 18% say that they were considered changing. Maybe after the device, maybe more, we'll reconsider and think about changing the domicile. And
Well,
we
that's because everyone already changed it after the elimination of the deduction for state and local taxes. So everyone's already done it.
they're already left New York.
Mhm.
Well, I think we had a couple questions about New York City, so I wanted to focus on New York City for a minute. One of our attendees asked, I'm just going to read his question, does living on Long Island, and you kind of touched this point, and enrolling kids in school and not returning to the city from February through December, but plan on coming back after things get back to normal, is that a city resident?
It depends. Where the kids were going to school in the city before, enroll a school in Long Island, that's certainly a big help. You got to look at everything else. Have your business connections changed? Has your time spent, which isn't necessarily a day count test kind of thing, but quality of time. Did you spend more time in Long Island now than in the city? It really, really depends.
But let me just say
you
this.
need to keep in mind, also keep in mind that if you were still in the city for more than 183 days during the year, all bets are off. So it doesn't matter if you change your domicile.
Right.
You need to also watch your day count in the city still.
Right. And I don't know, maybe I misheard the question, but if there's any implication that this is, sort of temporary, then from the get-go, this is not a change in domicile.
We have another question that's really coming from the viewpoint of the employer. And the question is that they have a lot of employees who've left New York City and they changed their tax forms so that they're New York City non-residents. So what's the requirement for withholding? Or what's your
See our Thursday presentation.
See you on Thursday, yeah.
Seriously, we're covering the employer implications on Thursday, and that's what we're going to spend the hour on.
And just a little, for those of you who haven't read it, we're covering that. We're also covering other things like a business nexus, sales tax nexus, corporate income tax nexus, withholding tax nexus on Thursday, all related to the telecommuting workforce. So stay tuned.
So going back to New York City, if you have a client who has an apartment in New York City and was previously a statutory resident, is there any way to, if they're not spending the time in New York City, could they be considered a non-resident?
Yes, especially if they were just a statutory resident. If they, for example, the typical problem area is someone who maybe lives on Long Island or Connecticut or Westchester, goes home there virtually every night, but they have a place in the city that they occasionally stay in. Maybe they only go there 5 or 6 weekends a year because they can afford to do it and they like the luxury of having it, but they work in the city every day and they've been a statutory resident for that reason, because they were there for more than 184 days, because they work there every day and they have a permanent place of abode. Keep in mind, it doesn't matter that they slept there only 2 nights during the year. Does not matter. They were there for work more than 183 days, and they have an apartment that's available to them. Now that they are working from home, their true home, there's a very good possibility their day count is under the 184, and they're going to save themselves the New York City tax. The important thing to keep in mind is that the burden of proof is always on us taxpayers, and you need to keep contemporaneous records of where you've been. Cell phone records are checked carefully by the state and city auditors. They subpoena them if you don't want to turn them over, easy pass, all those other wonderful things. And you need to affirmatively prove that you were not in New York City. So get those records together.
I have an example right on point, Wayne, that you just mentioned. I have a client who has an apartment in the city and also has a home out on Long Island, and they travel frequently. Now, New York City, New York State have a travel exemption, meaning that if you just come through New York to use the airport or New York City to use the airport, and that's all, literally don't do anything else. It's just you're in travel mode. That doesn't count as a day in New York City or New York State, but in this particular example where you're trying to say, well, I didn't spend 184 days in New York City, and you are flying into the New York City airports, the telephone records can be very, very instructive, because in our case, our taxpayer really lives out on Long Island, and what we were able to decipher from the cell phone records is that you see the landing, you could see that the cell phone go on at Kennedy Airport, and then you can see in the car, you can see as it's tracking from different parts of the city, suddenly it's in Nassau County, and then it's in Suffolk County, and you can see where it ends, and it's very obvious that that is not a New York City day. So
it's also very obvious when you turn your phone off.
Well,
they're aware of that too.
So the point is, your phone can help, your phone can hurt, and these are things that you need to plan. So you need to actually plan these things if you're really trying to monitor your residency status. You need to think about all these things, including phone usage.
So often in the most difficult circumstances, there's an opportunity. So can you guys speak to how it may be possible for individuals to recognize potential tax savings during these critical times?
Yeah, well, we mentioned that I just mentioned that you may no longer be a statutory resident in a high tax jurisdiction like New York City / New York State. Also, as a non-resident employee who's working from home, you might be able to source some income outside of the state where you normally work if there's no convenience rule. So if the state where you normally work has a higher tax rate than your state of residence, there's potential savings there. You just need to really document that time and be able to prove where you spent the time. Rich, you have anything to add to that, or
did you mention? Pardon me, but did you mention the work at home rule and how that could affect your savings? Okay,
I did not.
Okay, so then let me do that. I can do something. So part of this. So some folks are going to be working from home in jurisdictions that have a lower tax rate than where they normally work. And, there's only a handful of states that have the convenience of the employer, convenience of employee tests that we discussed. What does this mean? It means that if you normally work in a state that is not your state of residence, but because of COVID-19, you're working from home in your state of residence, or vice versa. Actually, it's vice versa. Actually, if you're working, no, it's not vice versa. If you're working in your home, and if the state where you normally work does not have a convenience of the employer test, and most of them do have convenience of the employer tests, then the days you're working at home are going to be your home state source income. Your non-resident state isn't going to lay claim to taxation on that income. That could help you. It could also hurt you, but it could help you if your home state has a lower tax rate than the state where you normally work. And that's why it's important to be mindful of, if you're in that, if you're lucky enough to be in that situation, just be mindful, make sure you're not in one of those states that has a convenience of the employer. You're working in one of those states, because then it could very quickly not help you. Anything more on that, Wayne?
No, I think that pretty much covered it.
So, you've given a lot of great advice, a lot of things you've mentioned. What would you suggest to our participants on how to stay ahead of this issue?
Well, again, it's there's a lot of moving pieces right now. There's a lot of uncertainty in terms of public policy. How we've discussed how the states may be changing their policies on withholding, changing their policies on when they'll allow a resident to take a tax credit for services performed elsewhere. There's a tremendous amount of uncertainty regarding how states will give consideration to the convenience of the employer test. So there's a lot of things we don't know, but there's also some things that we do know. We know that it's perhaps now more than ever, it's important to keep track of the number of days that you spend in a particular state. So if you are spending fewer days in your home state, or let's say your state of statutory residency, be mindful of how close you are to the 184-day mark. If you're sheltering out of state, maybe it makes sense to stay there even perhaps a little longer than the state of emergency, if the state of emergency is to end. Because that could potentially allow you to avoid being a stat resident in a place where you're a stat resident, and again, depending on the tax rates and depending on whether or not you may be domiciled in another state, it may also avoid the potential for double taxation of unearned income, like interest, dividends, capital gains, and stuff like that. So it may give you the opportunity, if you were formerly resident in 2 states, it may give you the opportunity to be resident in 1 state, or it may give you the opportunity to abandon residency in the state with a higher tax rate and acquire residency in the state with a lower tax rate. And it's going to be important to be mindful of the sourcing rules for non-residents. Understand, again, whether or not the work that you are performing at home in the state where you don't normally perform those services, whether or not those are going to be considered sources, income earned within that state, whether or not there's going to be a competition for those, to tax those wages between the state that you live in and the state that you work in. That's a conflict you want to avoid, and you're also going to want to keep meticulous records on the number of days total number of days that you work in the year, and the number of days that you work in your home state versus elsewhere. I think what's going to happen down the road is there will be more clarity on how states will be interpreting the convenience of the employer test. There's going to be a lot more states that are going to be policy on where they will source income during the stay-at-home orders, and there will be a lot more states providing guidance on the credit mechanisms, under what extent they'll liberalize the credit mechanism so that taxpayers can take advantage of that. But
it's also a great opportunity for the feds to finally step up and bring some consistency into all of this, but I don't think that's going to happen, especially with all the other things that are going on right now, but it would be nice to see that too.
I think also from a domicile perspective, again, if you've been thinking about changing your domicile over the last few years and you just haven't pulled the trigger for whatever reason, keep in mind that you may never have a better opportunity to initiate a change in domicile.
I think the biggest trigger and the biggest factor is that people aren't going back to their offices or reopening their offices. They've seen that things are going well for them outside of New York City, New York State, or wherever it may have been. So I think that's going to be a big motivating factor. That's what I've seen.
Yeah, there could be people who say, you know what, I didn't really want to live where I'm living. My employer was around here, and now I don't have to live around here anymore. I want to be off where I want to live in Utah where I can go skiing, or off in Florida where there's more sun and no income tax, by the way. But so I think you're going to have to take. It's a good time to sort of take a look at these issues, because I really believe you will never have probably a time as good as this to be able to explain why it is that you change your domicile. And let me give you a little more background about what happens on an audit and these domicile audits. Frequently in a domicile audit, unless somebody has sold their house in their state of domicile and acquired one and completely left, that's a black and white situation. Most of the cases are not black and white. Usually someone still continues to have a home in their original state of domicile. And so what ends up happening in the audit is you may at first be arguing whether there's a change of domicile. But then what ends up happening is often it's a multi-year audit. You're arguing and settling on, okay, well, I didn't change my domicile, January 1st, 2020, maybe I changed it on the end of March 2020. And so what frequently happens during the dynamic of the audit is you're arguing over when exactly did it happen during the course of the audit. The auditors will maybe agree, yeah, you changed your domicile, but we think you changed it. Of course, they'll always take the latest point because it's more revenue for your home state.
You changed it after that $20 million capital gain that you realized.
Exactly.
Always.
Yeah. So, but if you have a really strong rationale, right, it's harder for them to push the line, further out. So that's what I mean when I say this is.
Let me see if I'm going to ask you a question as it relates to what you just said, Rich. Someone asked to change your domicile, they want to move to another state, or you have to move to a particular place. This is the example they give. On date 1, they left New York City and they moved to their parents' home in New Jersey. They didn't buy a house in New Jersey until date 2. What date did they change their domicile? Would be date 1 or date 2?
Well, that's exactly, that illustrates exactly the point. Okay. And depending on a lot of other factors, like, for example, what happened between those two periods. For example, if they went to New Jersey and they just started a new job in New Jersey at that time, even though they may not have, acquired their own home in New Jersey quite yet, they may still have a strong argument that they left New York before actually acquiring their own very own home, so to speak.
If they gave up their New York home but didn't buy one in New Jersey yet, but did change the job there and did move in with their parents, there's a good case there. I mean, especially if they gave up something in New York.
Right. And and with the pandemic, if that happened to the timing happened to be, I'm assuming this has something to do with the pandemic. There's two arguments there. There's one is the pandemic is the reason why you permanently changed, or the pandemic was a temporary escape and it was just a temporary thing. So you have to take a look at your own facts and figure out what it is.
I think also if your parents kept your room exactly as it was when you were a kid, it shows you never intended to leave. So maybe you were always in New Jersey domiciliary.
Oh yeah, well, That's a good point to consider. We had our third poll that was sent out, and the question we asked our participants is whether they're keeping track of the number of days they spend in the state. The majority, a lot of people, it looks like they are, but the majority doesn't look like they're keeping track of it. And I guess, guys, the number one lesson from today's webinar would be that you should document your, make sure you've kept good, adequate records of the time you spent outside the state.
Yes, and also, and not just the sheer amount of time, but also the amount of working time and where you're working as well. So there's just how much time am I spending in a state? There's also how much time am I spending working in a state relative to other places? And then, and then coming back to the final, or one of the final points is simply, what do I want to do now? I kind of have, I may have already moved out of New York because of COVID. Am I going to come back? Do I want to just draw the line in the sand now and say, this is it? See you, so long New York, or so long Connecticut, or so long Arkansas.
And if you're another important lesson to take away, if you're sitting on unrealized gains, if you're anticipating an unrealized gain, you can control when you change your domicile. And that's okay. You're allowed to do that. We plan with some clients for years their exit strategy, selling the business or selling stock at a certain time, and plan the move accordingly. And you're allowed to do this.
Yeah.
So we've received a lot of questions today, and we're not going to be able to address all of them. Our time is almost at the end, but we're going to do our best to respond in the coming days after the webinar. Many of the questions that we received were relating to withholding rules and other employer issues. So I want to remind everyone that we have a fantastic second webinar on Thursday at 10:30 that's going to address all these issues plus many, many more topics. Right, Rich and Wayne?
Yeah,
Yep.
it'll be great.
It'll be fantastic. I want to thank everyone for attending. Thanks, Rich and Wayne, for all the information. Mark your calendar for our next webinar this Thursday at 10:30. And if you have any further questions, please contact one of our panelists or your Berdon tax person advisor. And please enjoy the rest of your day. And everyone, please stay well.